Earn predictable rates of return averaging between 7 to 10% on your money, totally income tax free. In this educational episode, I'm going to be talking about why the third key element of a prudent investment is a rate of return, especially a predictable rate of return. And it does not have to be a pie in the sky rate of return. You want to average between 7 to 10%. I have been doing that now since 1980, and I will prove it to you and show you why next. So I'm Doug Andrew. I've been a financial strategist and retirement planning specialist now for nearly 5 decades, helping thousands of people in America optimize their assets, minimize taxes, and empower their authentic wealth. Now, one of my favorite financial instruments, if you've watched very many educational episodes on this channel, is a properly structured, max-funded, indexed universal life insurance contract. And if it is structured correctly and funded properly, it is deemed a laser fund. Now, laser is an acronym that I've used for years that stands for Liquid Asset Safely Earning Returns. And I've written 12 books thus far, but this book has been flying off of our warehouse shelves. It retails for $20 on Amazon. I'll gift you a copy free. Stay with me to the end of this episode, and I'll show you how you can claim a free copy. But let's talk about the key elements of a prudent investment. You know, a lot of financial advisors put these in reverse order. The number one key element of a prudent investment is liquidity, okay? And I have several YouTube videos about liquidity, the ability to access your money when you need it. Number 2 is safety, not only of the institution, but safety of principal. Whatever I set aside, I don't want to lose. And any year I make money, I want that to become newly protected principal. The third key element is rate of return. That's what this episode is about. Now, a lot of advisors flip those, and they're out to try to make you a bunch of money first, but they throw safety and liquidity out the window, and so you can't access your money when you need it without triggering tax or penalties, and the safety is not there because a lot of times when you're trying to go after rate of return, the higher the rate of return, the greater the risk. No, I want the highest rate of return with the least amount of risk. The best instrument to accomplish that is a laser fund. Now, let me show you what I have historically been able to earn on my laser funds. This all started clear back in 1980. E.F. Hutton, who was not really an insurance company, they had an insurance division, but they were a brokerage firm. They helped people buy mutual funds and stocks and bonds and what have you, and they began to realize that people would have to be averaging 12% in the market to net 7% after taxes and fees with their asset managers. Because if you were earning 12%, and I know there's advisors out there that keep saying, hang in there, you should average 12% in the stock market. In actuality, Dalbar, who studies investor behavior, has disclosed that if you bought and held, and you didn't panic when the market started to crash, and when we go through these topsy-turvy times, you would average 9.14% in the market in any 20-year period since the Great Depression. And so it's really more like 9%. But, you know, they tell you, hang in there, you should average 12. Well, what E.F. Hutton realized, well, even if we could average 12%, and you accumulate $1 million nest egg for a retiree, and if they were really earning 12%, theoretically, they ought to be able to pull out, 120 grand a year without depleting their $1 million nest egg, right? Well, you pull out 120,000 and you have to pay federal income tax on that if it's a tax-deferred IRA 401k. 41 out of 50 states has a state income tax. With the federal and state tax, most people in retirement are paying out about a third in taxes on their IRA 401k money. And that's going to even be more because of irresponsible government spending and the printing of money. They're going to go after the people who have the money. Okay, that's a whole nother subject. But whenever the government is hard up for tax revenue, where do they go? They go to the people who have the money, and that's savers that are preparing for retirement, and it hurts them the worst. let's get back to this 12% assumed rate of return. You pull out $120,000 and you pay a third, $40,000 in tax. You're netting $80,000 to buy gas, groceries, prescriptions, and golf green fees, but you're not netting $80,000. Most of these asset managers on $1 million nest egg are charging you at least 1% in asset management fees. So that's another 10 grand. So if you're earning 120,000 after tax and fees, you're only netting 70,000 or 7%. E.F. Hutton, they just went, what are we thinking? We could actually put people's money in the multi-trillion-dollar insurance industry, and we would only have to earn 11% to net 10 because the 1% is not taxes. 1% is the cost of the insurance that the IRS says has to be there in order for it to be totally income tax free. And I'm talking about a max funded indexed insurance contract now, because you're taking the least amount of insurance the IRS will let you get away with, and you're putting in the most money that the IRS allows as fast as they allow, and it turns into a tax-free cash cow. This was the brainchild of E.F. Hutton. It was designed for living benefits. Life insurance was for life, not for death. And so this was the emergence of universal life. And back then, interest rates were high. I never got credited less than 11.75% from 1980 until the 1990s. I got credited as high as 15.5%. But I would earn 11 and net 10. I could put in, and I had many clients put in 500 grand, and they started pulling out 50 grand a year tax-free instantly, every year, without depleting principal. Well, in the 1990s, interest rates started to come down. And so in 1997, they came out with indexed universal life. Now, this is not an index fund. Okay. If you have money in an index fund like the S&P 500 index, you will lose money when the market goes down. When you're using indexing, your money is safe in the insurance company, but they have to pay you whatever the S&P does. And the way that they can afford to do that is they take the interest they're earning on your million. Even if they're only earning 5% interest, that's 50,000 of interest on your million. And instead of paying you that interest, you're telling them you can use the interest on my million to buy upside options in the index or the indices that you chose, the S&P, the Dow Jones, the Russell 2000, whatever. You can diversify. But to keep it simple, that gives them the wherewithal to pay you $80,000 if the S&P went up 8%, or $120,000 if it went up 12%. But if the market crashes and it loses money, like 2001 to 2003 or 2008, when the market crashed 40%, not one of our clients lost one dime due to that market downturn. They may not have made much of anything. The options expired worthless. Zero was the hero, though. They made zero, but they didn't lose. And so through that Great Recession, many of our clients that started out with $1 million in the year 2000, without adding a dime, they ended up with $2.5 to $3 million at the end of 12 years, where most Americans, their million went down to $600,000 twice in that 12-year period, and it barely came back to break even. This is huge. And so the third key element of a prudent investment is earning predictable rates of return. And I'm not talking about pie in the sky rates of return here. I'm talking about averages of 7, 8, 9, 10%. Ever since indexing came out, and by diversifying and by rebalancing. What do I mean by rebalancing? I'll give you just a quick example, simplify this. In 2001, after the 9/11 terrorist attacks, when the market dropped down, I didn't earn anything, but I didn't lose. But that was the only year. The next 2 years, the market was still going down. So I just said to the insurance company, just quit linking my money and just pay me the 5%. So I made, on $1 million, let's say, I made $50,000 each of those 2 years because I didn't sit there and earn zero. Same thing happened in 2007 when the market went down. I earned zero, but I didn't lose. But 2008, I made 5% when everybody else lost 40%. And so instead of in that decade from 2000 to 2010, there were 5 down years and 5 up years. Instead of having zero rate of return in half of those years, I only had 0.2 of those 10 years. And so instead of earning 7.23%, for the people who were just leaving their money linked to an index with 5 down years and 5 up years, The average return is 7.23%. Your million would have doubled to 2 million. But I ended up with more than 2.5 million because I rebalanced. When I have done that since 1997, I have averaged 11.17%, and I've netted cash on cash 10.07, meaning 1% at the end of the day has gone out towards the cost of the insurance and the fees that the IRS has to be there in order for it to be tax-free. But those aren't pie-in-the-sky rates of return. I can earn 11 and net 10. I can earn 10.5 and net 9.5. But even at 9.6%, which I've averaged since 1980 before indexing, 9.6 divided into the rule of 72 means your money will double every 7.5 years. I've had people who put in 500,000. It doubled to $1 million in 7.5 years. Another 7.5 years, it doubled to 2 million, then to 4 million, then to 8 million by the 30th year. And they now have $8 million, and it's generating a rate of return of 600 to 800,000 a year. We have clients, they don't even need that much money. They only need 300,000. So it's continuing to grow by $500,000 a year as a hedge against inflation. This is one of the best financial instruments to give you a predictable rate of return tax-free. I'd rather have a tax-free return of 9 or 10% after 1% going out towards the cost of the insurance than have to earn 15 or 16% in a tax-deferred IRA or 401k in the market, and then pull out $160,000 to net $100,000 to buy gas and groceries. I just want to pull out $100,000 to net $100,000 because it's totally tax-free, and my nest egg lasts longer because I can pull out less money. Is this making sense? So I want you to know that rate of return is the third key element of a prudent investment, but you don't want to go after a rate of return at the expense of lacking liquidity or safety on your money. That's why my favorite vehicle is a properly structured, max-funded, indexed universal life insurance contract. It's deemed a laser fund. If you would like to study more about this and see how this may apply in your particular set of circumstances, claim your free copy of this 300-page book. It's actually 2 books in one. This side is about 200 pages, comprising 14 chapters with all kinds of charts and graphs and explanations if you're a left-brain learner. If you're a right-brain learner, you flip it over and read this one. This is about 100 pages, 12 chapters with 62 actual client stories of how the laser fund can be used for all kinds of financial goals, not just retirement. If you want to use your whole brain, read both of these books, okay? But this retails for $20 on Amazon, plus you pay shipping and handling of about $10. I'll gift you one for free. You simply go to laserfund.com or click on the link below. You contribute a nominal amount towards the shipping and handling. I'll cover the rest of that cost, and then I will fire out a hard copy to you via priority mail. But when you're in there claiming your free copy, if you like to listen and learn or watch and learn, check out the audio and video formats. There's even an 18-hour masterclass that you can invest in. We teach regular educational webinars. They're free. You can even schedule an appointment in there to talk to an IUL specialist, which are the top 0.1% in America that I have trained and I oversee. And without any cost or obligation, they'll show you illustrations of how a laser fund may work in your particular set of circumstances. So this is to you and your brighter future.